Hi guys, it's Shafman from Shafman TV. I hope you're all well. Today we're looking at whether the UK actually has a consumer debt bubble, and if so, what are the implications for the economy and investing and such like. So, recent figures are out to show that household unsecured borrowing has topped 200 billion pounds. Yes, that's 200 billion pounds. We've also got some further data from last year from I believe they're called the Finance and Leasing Association, which is involved in leasing cars, selling cars via car finance dealerships. And in 2016, the figure there was 31.7 billion. So we've got household spending on things like credit cards, unsecured loans, store cards, over 200 billion and rising. And we've got car finance as well as another issue. So uh, it looks, in my opinion, that you have a consumer debt bubble forming in the UK. And generally speaking, if you were to place some odds upon an outcome, in my opinion, it looks like that bubble could quite easily burst at some point. So the question is, why has this happened? So since 2008, since the financial crisis in 2008, uh, the rate of interest has plummeted, and you've had the availability of cheap money. So central banks like the Bank of England, for example, have been buying bonds and printing currency, and they've been able to lend that money to commercial banks and high street banks at very low rates. And what has happened potentially, the Bank of England may have done this unintentionally. It has meant that unsecured lending has proliferated in the UK. I read actually recently that there's something like over £1 billion every calendar month which is borrowed by people on credit cards and like store cards and loans and various unsecured methods. So back onto the previous point, the cheap lending by the central banks to enable European banks, US banks, British banks to have available cheap currency, money, has enabled those banks to then probably uh, in a very irresponsible manner maybe to lend that money out. Now, why have they done this? um, Generally speaking, in the past 10 years, banks have struggled immensely. They've gone from being very profitable businesses that have very good dividends and lots of free cash flow to like very, very much out of favor. They've tried to streamline operations. I read recently that in the UK, for example, PPI banks have paid out something like 150 billion pounds in PPI compensation and various other scandals. It's a lot of money that they've lost. So what that's potentially pushed banks to do is to find things, find profitable avenues, because the residential mortgage market looks not particularly profitable. Maybe you can obtain a mortgage at 4 or 5%. There's not that much profit to be made. Whereas a credit card at 17, 18, 22%, whatever it may be, is a highly profitable business for a bank. And you'll see recently, if you follow the news, the financial news, that Lloyd's purchased MBNA. And one of the reasons they purchased MBNA is because their underlying profit margin was wafer thin. I believe it was 0.1%, and they need to engage in lending, which is going to be more profitable, and credit cards are very profitable. So back onto the consumer, back onto you and I, this debt bubble on an individual level is really dangerous to our finances, because basic maths will show you that if you're having to pay 18% interest, for example, on a credit card or a store card or whatever it may be, then if you're unable to obtain 18% interest on that money, then basically you're losing. You're on the wrong side of the transaction when you have this type of credit card debt. Now, a wider implication for the economy is that credit card debt and consumer borrowing has driven the economy on. Okay, so since the financial crisis, pretty much across the board, wages have stagnated, but prices have gone up. But yet consumer spending has continued. Now, it doesn't require a rocket scientist to work out that if people are not being paid more, but they're spending more, they're obviously getting that money from somewhere else. Credit cards, store cards, whatever, loans. So at some point, there will be, in my opinion, a moment of reckoning. Now, there's a really good quote by Warren Buffett. I really like a lot of his quotes, but this is particularly one that I really enjoy. And he says that only when the tide goes out will you know who's been swimming naked. So only when the tide goes out, only then you'll know who's been swimming naked. And this is the same with debt and this consumer credit bubble which has formed. And if you look at all the other previous bubbles, stock market crashes, and you look at the subprime mortgage issue in the United States leading up to the 2008 crisis, it was very obvious that if you look at the figures, the devil's in the detail, if you looked at the figures of some subprime mortgage lending and you looked at how this debt was being passed around different financial institutions, it was pretty obvious to work out that a bubble was forming in the housing market in the United States. And it's pretty straightforward to me to see that there is a consumer debt bubble that could burst any moment. Now, I'm not saying that it's imminent because of the low rate of because of the low rate of interest that we're in. People are able to refinance, balance transfer credit cards, but it's a pretty ominous sign for the UK economy that there is such a high level of unsecured borrowing in the economy. It really isn't a good thing. Now, will it burst? I don't know. I cannot make like a guaranteed definite prediction. I don't really make predictions, but what I'm saying is that it's something to be conscious of, because the implication of individuals starting to default on loans and to be made bankrupt, or whatever the implication may be, would be a loss of business confidence and a loss of consumer confidence, and that would then feed into probably a reduction in consumer spending, which would probably feed into a retraction in the economy, which would be a recession. So it's 10 years since we had a recession, and the implication of this level of debt could be one almighty large recession. What would that mean? Unemployment, assets go down, house prices reduce, stock markets reduce, general recessionary feeling in the economy where confidence has ebbed out of the economy, and it obviously is would be a very bad thing for most people. So the point is that we should keep an eye on the level of debt that we see in any economy, because to widen this out internationally, Chinese companies have a large level of debt, and as Buffett says, when the tide goes out, you'll know who's been swimming naked. And there can be a moment, an inflection point, where something happens, where something goes wrong, and the bubble bursts, and the implication to the UK would be pretty bad. Obviously, in addition, in the past year, we've had Brexit, we've had the devaluation of the pound down approximately 15 to 20%. We've got inflationary pressure in the economy. We've got low levels of unemployment, but we have underemployment, and we have stagnant wages. There has been a lot of talk of secular stagnation, of stagflation as well in the UK, where prices rise but the economy doesn't grow, similar to what happened in Japan. So We've also got potentially, if you believe some of the figures, a £1 trillion pension deficit. If you add up all the pension schemes in the UK, there is a £1 trillion pension deficit liability there due to the low rate of interest and various other things. Bonds not performing as well as potentially they should have. But you have a heady cocktail. Now, I'm not a fundamentally negative person. I don't believe in just analyzing all the negatives, because the UK's got a lot of strengths which other countries don't have. You know, it's a really important large economy. The output of the economy is something like £2.3 trillion, so a lot of output. But what I'm saying to anybody that's wants to listen is that these debt bubbles and this type of, well, I'm not going to call it hysteria, but these statistics should be something to be aware of. And on a personal level, my only advice to anyone is don't get into high interest debt. Don't get into debt. Just avoid debt. It's just, if you want to buy something, save up and buy it. Don't buy things that rust, rot, and depreciate and get into debt to pay for them. It's just a stupid idea. I can't even dress it up any other way. It's stupid. Being debt free is a very good position to be in, and it's an underrated position. So yeah, I hope this has been useful. I'd love it if you would subscribe to my channel, and thanks for listening, and I wish you a great day. Thanks a lot. Thank you.